Hello and welcome back to The Note. In the long run, everything's a toaster. That's a phrase that comes from Bruce Greenwald, who teaches the value investing class at Columbia Business School that helped launch Warren Buffett to fame and fortune. And it's a classic value investors warning to growth investors. What it means is that in the long term, you can have lots of exciting innovations if you like, but in the long term, everything is going to turn into a toaster. It's going to be a commodified product that competes on price. Now, the question for today is whether the classic non-value stocks, tech stocks, have now actually reached the point where they are making toasters, or at least where they're being priced as if they're making toasters. And there's some very interesting evidence that they are. Now, we tend to look back on the dot-com bubble as a moment of utter mania, and obviously lots of dot-com companies, perhaps most famously Pets.com with their glove puppet, were valued at ridiculous levels. But the same thing also applied to real companies that were making real physical objects, of which the most famous example has to be Cisco. What we're looking at here is Cisco's share price going back to the bubble. And you can see that it's still nowhere near where it was at the peak when it was briefly the largest company in the world by market cap. But now let's take a look at its earnings per share growth over that period, and you can see that it's done fine in the intervening decade or so. Its earnings have risen very impressively and very consistently. The reason we've seen such a fall off in the share price, we can see quite clearly here, is because the price earnings multiple was at one point quite ludicrous, more than 200 times historic earnings per share, plainly unjustifiable on any planet, whether you're making iPods, toasters, or anything else. Now, there's another way we can look at this, which is to compare tech stocks to utility stocks, arguably the ultimate boring, safe investments. What we're showing you here is the PE multiple on the S&P tech sector and the S&P utility sector, along with two big famous names, which are Cisco and Apple. You can see that they've converged quite dramatically over time, and if we actually now take a look in close up at the situation now, you can see that both Apple and Cisco are currently cheaper, judging by PE, they're currently cheaper than the S&P utilities sector. Quite remarkable statistic, particularly as some value managers will subtract out the more than $100 billion of cash that Apple has on its balance sheet and arrive at a PE multiple for Apple of less than 10. Quite remarkable statistic. Now, the impression that many people have is that tech has been doing well because of the few standout exciting names, noticeably Google recently passing $1,000 a share for the first time. If we take a look at this chart, you can see that the S&P tech sector has actually underperformed the market as a whole, not just obviously since the top of the bubble, but also over the last year or so. It's not particularly in favor, and that means that even though large cap stocks are not normally the best place to go looking for value, it looks as though there may be value in technology companies. They tend to have strong balance sheets, and the bigger ones tend to be well protected, and yet they are being priced as though they are making toasters. Now, there are two arguments here. The first argument is that a toaster manufacturing company is not necessarily a bad thing to be if you're a well-run toaster company and available at a fair price, which it would appear that some large tech companies now are. The second point is that it still looks rather premature to say that some of these companies are making toasters. Now, it's true, there is a lot of risk in technology. If you want to look at products which were once truly hegemonic, like the Palm Pilot or the BlackBerry, or maybe even the original iPod, they're not so much toasters now as broken toasters. They're completely obsolete, so maybe there is some more risk there. But there are also plainly plenty of opportunities for growth still in a number of these companies. So it does look as though they are being treated perhaps prematurely as being ex-growth, and so it does look very counterintuitively, and more than a decade on from the bubble, as though some large tech companies now actually offer value.